In this video, you'll learn how payroll accountants determine federal tax withholdings using the percentage method. First, let's recap though what federal withholdings are. There are two methods for manually calculating federal income tax withholdings and how to calculate taxable income. Mandatory paycheck deductions include federal income tax for all employees. This is an employee-only tax, which means that the employer does not contribute a matching amount like employers do for FICA tax. The starting point for calculating the federal tax withholdings is the Form W-4, which is completed by the employee on paper or online. The employer acts as the collector and depositor for these federal income tax withheld from the employee's paychecks. When the employee files their income tax return, the amount withheld from his or her paycheck during the year reduces the amount the employee may have to pay with their tax return. It is important to note that federal income tax is reduced by pre-tax deductions, such as the employee's payments for health insurance, 401k, and cafeteria plans. That means that employees can reduce their federal, state, and often also Social Security tax withholdings through pre-tax deductions. Many companies use software programs or an external service to calculate the federal income tax withholdings. However, if a company uses a manual system, there are two commonly used methods for calculating federal income tax. One, the wage bracket, and two, the percentage method. In this video, I'll cover the percentage method. Please see the prior video to learn about the wage bracket method. But first, let's look at two examples of how pre-tax deductions reduce period wages to arrive at taxable income. The first example is for Heather, who's an employee with a period gross wage of $2,815. She elects to have 5% of her gross pay withheld for her 401k contribution and has no other pre-tax deductions. What will be her taxable income for federal income taxes? We write down the gross amount of $2,815 and then calculate the 401k deduction, which is $2,815 times 5% or $140.75. We subtract the pre-tax deduction from the gross pay, which results in $2,674.25. What about the next example? Amanda Brady has gross wages of $950. She has subscribed to the company's cafeteria plan, and she has agreed to a 10% investment of her gross wages in a qualified 401k plan. Her portion of the health insurance is $56.90 per pay period. So first we'll write down Amanda's gross wages of $950 and calculate her contribution to the 401k by multiplying $950 by 10%, which is $95. We write this amount down as a pre-tax deduction and then enter the pre-tax deduction for the health insurance of $56.90, arriving at taxable income of $798.10. The second method for calculating federal income tax withholdings for employees when the employer uses a manual payroll system is the percentage method. Publication 15T, which we previously used for the wage bracket method, as well as your textbook Appendix C, includes the percentage tables. The percentage method for calculating employee withholdings is tiered, with each layer building upon the previous layer. The computations in these tables were changed in 2021 to make them more consistent between the withholdings per pay period and the amount calculated on the annual tax return. So how is this method different from the wage bracket method? Well, it is more exact. The wage bracket table has bands, and within that band, each employee has the same dollar amount of federal income tax withholdings, even if the wage differs. That's not the case with the percentage table because the calculation is based on the exact taxable wage of the employee. The percentage method also allows more flexibility for calculations involving high wage earners or uncommon pay periods. But the wage bracket method is simpler for manual payroll tax computations. So let's take a look at this table. At the very top, we see the title 2023 percentage method tables for manual payroll systems with forms W-4 from 2020 or later. And underneath the title, we see the payroll period. In this case, it's the weekly payroll period. Below that, we have the left side with the standard withholding rates, schedules, and on the right side, the tables for those employees who checked Form W-4 checkbox 2. Below that are the categories of marital statuses, married filing jointly, single or married filing separately, and head of household. If we look at the first section on the left side for standard withholdings and married filing jointly, we see that the table starts off with a range of $0 to $533, with a tentative withholding amount of 0, which basically means that if you have a weekly payroll and your filing status is married filing jointly and you make less than $533, your federal income tax withholdings are 0. Well, let's look at row 2. Here we see $533 to $956. The tentative amount is 0 because the first $533 does not result in any taxes, but there's a 10% income tax withholding on any amount over $533. So let's say that the wage is $800. We would subtract $533 from $800 because only the amount over $533 is subject to the 10% withholding, which leaves us with $267 times 10%, which is $26.70. Here's another example for an employee with weekly wages of $1,500 and married filing jointly. We look in the table, and now we need to move to the third row. This row is for wages from $956 to $2,253, and it shows a tentative amount of $42.30. The amount represented the taxes on the first $956 of the employee's wages. We subtract $956 from $1,500, which leaves us with $544 times 12% equals $65.28, plus the tentative amount of $42.30, which equals a final tax of $107.58. Here's an example of an employee with dependents. Carolyn Smart is single and has 2 dependents under the age of 17 reported on her Form W-4 from 2023. She's paid semi-monthly and earns $51,000 per year. Does not receive any other income and does not itemize her deductions. Form W-4 Step 2 box has not been checked. Carolyn has no pre-tax deductions. We start with the period wages of $51,000 and divide it by 24 because Carolyn is paid semi-monthly. That gives us the semi-monthly wage of $2,125. Carolyn is single and did not check box 2 on the W-4. Therefore, we look on the left side of the table in the section for single taxpayers. Please be sure that you have the tax table for the correct payroll period. We find the right row that includes Carolyn's semi-monthly wage of $2,125. We subtract $1,035 from $2,125, which is $1,090, and multiply it by 12% for a tax amount of $130.80. and then add the tentative amount of $45.80 for a total amount of $176.60. However, we still need to give Carolyn credit for having dependents. Each dependent under 17 is worth $2,000 in tax reductions per year. Please note that the $2,000 only applies to dependents under 17. For other dependents, we use the lower amount of $500. In this case, though, the dependents are under 17 and we divide the $4,000 by 24 because that is the number of pay periods for semi-monthly payroll, which gives us $166.67, which we subtract from the amount of $176.60, which then results in the final federal tax withholdings of $9.93 per paycheck. Let's look at another example. In this case, Billy River is married and has two dependents under the age of 17, reported on her Form W-4 from 2023. She's paid semi-monthly and earns $96,000 per year. She does not receive any other income and does not itemize her deductions. Form W-4 Step 2 box has been checked. Her spouse earned $49,000 per year. Billy has no pre-tax deductions. So let's start off by dividing the annual wage of $96,000 by 24, which is $4,000. If Billy has any pre-tax deductions, we will deduct those now, but Billy doesn't have any. We then find the correct section of the percentage method table for a married filing joint lead taxpayer who has checkbox 2 checked of the Form W-2. The third row is what we need because it includes wages of $4,000. This row tells us that all taxable wage amounts above $2,441 are taxed at 22% plus an amount of $214.52 for the amounts below $2,441. We subtract $2,441 from $4,000, which is $1,559, and multiply it by 22%, which results in $342.98. To that, we add the amount of $214.52 to get the preliminary taxes of $557.50. We then calculate the semi-monthly tax deduction for the two dependents, which is $166.67. We subtract that from the preliminary taxes and end up with $390.83. Please keep in mind that the final tax amount cannot be negative. Therefore, if the dependent deduction is greater than the preliminary taxes, we enter 0 as the final taxes. What is left to do is to calculate the additional taxes for the spouse's income. We do that by pulling up page 4 of Form W-4 and finding the intersection between the highest paying job of the spouses in the row section and the lowest paying job of the spouses in the column section. In our example, that is $6,570 per year. We divide that amount by 24 for $273.75 and add it to the net tax amount of $390.83 for the final tax amount of $664.58.